The story of Japan's economy in the 20th century is nothing short of an economic miracle. After the United States, Japan experienced the most spectacular economic growth the world had ever witnessed. It was a rise that stunned global observers and reshaped the balance of power. Let us look at some data from the World Bank. In 1960, Japan's gross domestic product, or GDP, was a respectable over $47 billion. Fast forward just 3 decades, and this number exploded. By 1990, the economy had grown to a stunning over $3.1 trillion. The ascent did not stop there. Japan's economy peaked at an incredible $5.55 trillion in 1995. This was a pivotal moment. That very same year, 1995, numerous news articles and economic analyses were published around the world, all discussing one astonishing fact: Japan was catching up to the United States. To truly grasp the magnitude of this achievement, consider a comparative graph from the same source, the World Bank. The gap between the United States and Japan was surprisingly small in 1995. The United States economy stood at just $7.6 trillion. This proximity led many to believe that Japan was not just catching up, but was genuinely poised to surpass the United States. Other economic metrics even showed that Japan had already overtaken the United States in certain areas. For instance, in terms of GDP per capita, Japan had surpassed the United States in 1987, creating a significant gap between the two nations by 1995. This was, without a doubt, an economic miracle. Globally, no other nation, with the exception of China much later, had come anywhere close to challenging the economic dominance of the United States in this way. The world watched in awe as Japan ascended, transforming itself from a post-war nation into an industrial titan. Factories buzzed with innovation, and Japanese products became synonymous with quality and reliability. From the bustling streets of Tokyo to the quiet research labs, there was an air of unstoppable progress. The future seemed boundless for the land of the rising sun. But as many know, the story does not have a happy ending. Instead of continued growth, the world witnessed the eventual stagnation of Japan's economy. This was not a short-lived downturn for 1 decade, nor 2 decades, but over 3 decades of very little growth. Since 1995, Japan has not seen substantial economic growth. This stark reality is evident in a graph showing the GDP of both Japan and the United States. Extended beyond that peak period, the line for Japan flattens, a testament to what would become known as its lost decades. Many people often attribute this stagnation solely to the Japanese asset bubble. The asset bubble, which famously burst, did indeed cause the so-called lost decade, where Japan experienced not only stagnant economic growth but also deflation and declining asset values. It was a severe blow, undoubtedly. However, there is more to this story than just the asset bubble. There is another significant reason why Japan's economy has struggled to grow since those years. And some blame the United States for this. The narrative often focuses on internal factors, but looking externally reveals a fascinating and often overlooked aspect of Japan's economic fate. To understand how the United States played a role in Japan's slowdown, we must go back to the decades leading up to the 1980s. From the 1970s, Japan had firmly established itself as a global manufacturing powerhouse. It was not just participating in global trade, it was dominating key industries. Automobiles, electronics, and machinery were areas where Japanese companies excelled, setting new benchmarks for efficiency and quality. These were the very years that saw Japan conquer a huge portion of the semiconductor industry. This was also the time of the meteoric rise of Japanese automotive companies, such as Toyota, which revolutionized car manufacturing with its innovative production systems. The semiconductor industry, in particular, was one of the most pivotal aspects behind Japan's initial economic rise. And, ironically, it would also play a key role in its eventual stagnation. Consider a graph with data published by the Semiconductor History Museum of Japan. In 1981, Japan held an astonishing 69.5% of the market share in 64K DRAM. The remaining 30.5% was captured by the United States. Japanese companies like Hitachi, Fujitsu, and NEC were the undisputed market leaders in this critical category. What exactly was a 64K DRAM? And why was it so important in 1981? It was a type of memory chip, specifically a 64 kilobit dynamic random access memory chip. At the time, this was a technological marvel, pushing the boundaries of computing. DRAM chips are essential components in all computing devices, acting as temporary storage that enables faster processing of data compared to traditional storage like hard drives. In the early 1980s, the 64K DRAM represented the cutting edge of semiconductor technology. Its successful production and market dominance showcased a country's ability to lead in the tech-driven global economy, signaling a shift in technological supremacy. It was in this industry, along with many others, that gave rise to a concept called trade surplus. Japan was producing high-quality, competitively priced goods that the world, especially the United States, eagerly purchased. This led to a significant imbalance in trade. Let us look at a graph with data collected from the United States Census Bureau, which illustrates the trade between the United States and Japan from 1985 to 2000. As you can see, the United States had been exporting substantial amounts to Japan, totaling billions of dollars. However, at the same time, the United States had also been importing massively from Japan, much more than it was exporting. This created a consistent trade surplus for Japan and a corresponding trade deficit for the United States. What this meant was that a significant economic imbalance was forming between the two powerful economies. Japan's consistent trade surplus indicated that it was selling far more goods to the United States than it was buying. This led to a substantial accumulation of wealth and foreign reserves in Japan. This trade surplus became an important part of Japan's economic rise, funding further investment and expansion. You can even see this reflected in Japan's accumulation of total reserves. As reported by the World Bank, from 1960 to 2000, Japan gained a massive amount of total reserves, thanks to its strong exports globally and particularly to the United States. In the year 2000, Japan was even the world's largest holder of total reserves, with over $361 billion, a figure that far surpassed any other nation at the time. This accumulation of wealth underscored Japan's powerful position in the global economy. The growing trade imbalance between the United States and Japan did not go unnoticed. It became a significant source of political tension. American manufacturers, especially those in industries like automotive and electronics, felt increasingly threatened by the influx of cheaper, high-quality Japanese imports. These industries, once pillars of American economic strength, were struggling to compete, as political and economic pressure mounted from domestic industries and workers. The United States government sought a solution. The goal was to rebalance global trade flows and reduce its persistent trade deficit. This escalating situation led to one of the most dramatic policy decisions in post-war economic history, the Plaza Accord. On September 22, 1985, representatives from the G5 nations, the United States, Japan, Germany, France, and the United Kingdom, convened at the prestigious Plaza Hotel in New York City. Their primary goal was to address what they perceived as the severe overvaluation of the United States dollar. The dollar had appreciated by an astonishing 44% against major currencies between 1980 and 1985, making American exports expensive and imports cheap, thus exacerbating the trade deficit. The agreement reached was clear and impactful. The G5 countries would collectively intervene in currency markets. The objective was to deliberately weaken the dollar while simultaneously allowing other major currencies, particularly the Japanese yen and the German Deutsche Mark, to appreciate in value. For the United States, this was a strategic move designed to make its exports more competitive on the global stage and to reduce its crippling trade deficit. For Japan and Germany, it meant assuming a larger share of global demand by strengthening their currencies, effectively making their exports more expensive and their imports cheaper. Initially, the plan seemed to work as intended. The dollar depreciated by 40% between 1985 and 1987, and Japan's trade surplus began to shrink, signaling a rebalancing. However, The appreciation of the Japanese yen turned out to be far steeper and more rapid than anticipated by the policymakers. By the end of 1985, the yen had surged by over 50% against the dollar. This dramatic and swift change sent shockwaves through Japan's export-reliant economy. We can clearly see how this played out in the official exchange rate data. As published by the World Bank, from 1978 to 1985, Japan's exchange rate to the United States dollar was consistently trading around 210 to 249 yen to a dollar. This was a relatively stable period. Yet, by 1986 and in further years, the yen had appreciated drastically, falling to as low as 128 yen to a dollar by 1988. It is crucial to mind that these were just a couple of years. A huge surge in a country's currency value in such a small timeframe was truly a recipe for disaster for an economy built on exports. Whenever a country's currency rises significantly in value, it makes that country's products more expensive on global markets. This directly cuts deeply into the profits of export-oriented companies, making their goods less competitive internationally. We can observe this impact directly. Here is a graph with data published by the World Bank. The exports of goods and services as a percentage of GDP in Japan was over 13.6% in 1985. However, it fell to over 9.4% by 1988. A significant decline in just 3 years. To further depict its annual growth rate by year, we can look at another graph. In 1984, the annual growth rate of Japan's exports of goods and services was over 15.4%. But by 1985, it fell sharply to 5.3%, and then suffered a contraction of 5% in 1986. This steep decline was largely and directly because of the sharp increase in the yen's value, rendering Japanese goods less affordable for international buyers. This contraction in the crucial export sector had a domino effect throughout the economy, eventually leading to a recession in the mid-1980s. Faced with this sudden and severe economic slowdown, Japan's policymakers acted swiftly. However, their responses, while intended to mitigate the immediate crisis, inadvertently laid the groundwork for future and even greater crises. To stimulate the ailing economy and counteract the negative effects of the strong yen, the Bank of Japan implemented aggressive monetary easing policies. This involved slashing interest rates to historic lows. Let us examine a dataset published by the Bank of Japan for their interest rates. From 1983 to 1985, Japan's interest rates were over 5%, a standard level. Yet, by 1987 to 1989, these rates fell dramatically to 2.5%. These significantly lower interest rates were a direct response to the economic problems the country was facing at that time, aiming to encourage borrowing, spending, and investment. On top of these low interest rates, these measures were also accompanied by fiscal stimulus initiatives, which were government spending programs designed to boost domestic demand and inject money into the economy. While these combined policies did succeed in reviving economic growth in the short term, they also, critically, fueled speculative excesses in the real estate and stock markets. Money became cheap and plentiful, and it flowed readily into assets, inflating their values far beyond their intrinsic worth. By the late 1980s, Japan was undeniably in the throes of an immense economic bubble. The statistics from this period are almost unbelievable. Land prices in Tokyo soared to unimaginable heights. The Nikkei stock index, the primary benchmark for the Japanese stock market, tripled in value in a relatively short period. At its absolute peak, the estimated value of land in Tokyo alone was said to be greater than the entire real estate value of the United States. For a time, it genuinely seemed as though Japan was on an unstoppable upward trajectory. Impervious to economic gravity, the stock market of Japan provides one of the best ways to understand this rise in speculative excesses and the subsequent collapse. Here is a graph with data from the World Bank on the total value of stocks traded. As you can clearly see, there was an insane, almost vertical, rise in stock trade value from 1985 to 1988, precisely the same years when Japan's economy had started to feel the effects of the Plaza Accord and the subsequent monetary easing. In 1985, the total value of stocks traded was just a mere sum of $455 billion. Yet, just 3 years later, in 1988, this figure rose to over $2.54 trillion. It saw a further increase in 1989 to over $2.61 trillion. But then, as the graph vividly depicts, there was a crash, a fast, brutal crash in trade value the very next year. In 1990, it shrunk dramatically to $1.54 trillion. A further contraction was seen in 1992, plummeting to just $606 billion. This value was not seen again until 2004, nearly 2 decades later, illustrating the profound and lasting impact of the crash. The same tragic story can be seen in the market capitalization of listed domestic companies in the country. From a graph, you can observe that in 1985, the year where the market capitalization of listed companies was just $948 billion, it rose immediately and spectacularly to over $4.26 trillion by 1989. And then, it came crashing down by nearly half, to just $2.25 trillion by 1992. This was the bursting of the asset bubble, a catastrophic event that shattered consumer confidence, wiped out vast amounts of wealth, and plunged Japan into decades of stagnation. So, was the Plaza Accord the direct cause of the downfall in Japan? It is a complex question with no simple answer. At the time when the treaty was signed, it is worth noting that Japan was actually a willing participant in the agreement. Japanese officials and policymakers recognized the need for global economic rebalancing, understanding the unsustainability of the massive trade imbalances. Some Japanese policymakers even viewed the accord as a milestone, marking Japan's emergence as a key player in international finance, capable of influencing global economic policy alongside the United States and European powers. Hence, if they had accepted this treaty as fair and reasonable at the time, then the question becomes less about the treaty itself as an external imposition, and more about the long-term ramifications of its implementation and the subsequent domestic policy responses. Secondly, and critically, Japan's response to the accord exacerbated its problems. The decision to lower interest rates and fuel credit expansion, while an attempt to cushion the blow of the rising yen, created the perfect conditions for the asset bubble to inflate to dangerous levels. Had Japanese policymakers, arguably, acted with more caution and foresight in their monetary and fiscal policies, then the economy may not have stagnated this much, or at least the crash might have been less severe. They faced a difficult choice, and the path they took, while initially seen as necessary, ultimately led to profound consequences. The Plaza Accord undeniably triggered a chain of events that profoundly altered Japan's economic trajectory. While it was a multilateral agreement, its primary goal for the United States was to rebalance trade, which directly targeted Japan's export-led growth. The subsequent yen appreciation was severe, pushing Japan's economy into a corner. The domestic policy responses, aimed at stimulating growth, inadvertently created a speculative frenzy that, when it inevitably burst, left a lasting scar on the Japanese economy for decades. It is a sobering reminder that even an economic miracle can be profoundly affected by global economic pressures and the policy choices made in response. The story of Japan's rise and subsequent stagnation is a complex tapestry woven with international diplomacy, economic theory, and the often unforeseen consequences of well-intentioned decisions. The role of the United States in initiating the Plaza Accord, and Japan's subsequent policy decisions, undeniably played a crucial part in shaping the economic landscape that exists today. But anyway, do let us know what you think. Thanks for watching.